All right, stocks hitting a wall after a big day yesterday. 30 minutes until the official start of trading. I'm Katie Greifeld.
I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, fresh retail data suggests that consumers remain resilient as investors await the final Fed decision of the year. There's also a new AI darling taking the spotlight as Nvidia falls into correction territory. We'll take stock of Broadcom's massive rally and deal makers optimistic about Trump's second term that will fan the flames of the M&A recovery. We'll speak to the top tech banker at Barclays later this hour. All that and more coming up. Let's take a look at where markets are trading. Of course, like I said, 30 minutes until we hear those opening bells. It is none too pretty. The S&P 500, after a rally yesterday, now down about 3 to 0.4%. It's big tech that is really interesting. We know that the Nasdaq 100 hit a record high yesterday. That was propelled by an 11% rise in Broadcom. Taking a bit of a breather this morning, the Nasdaq 100 down about 0.3%, and the 10-year Treasury yield. This is where all of the quiet action has been. We are back above 440. Not a big move this morning, but the 10-year yield creeping higher and higher, Sonali.
And as we've been talking about just yesterday, that 4.5% danger zone is on high alert. Katie, let's take a look at some of the stocks under the surface. Nvidia, as you've been talking about it, extending declines. It hits correction territory. It's been down 10% since December 5th, down 1.2% nearly today pre-market. Pfizer, though, up 2.4% pre-market, higher after forecasting 2025 sales in line with expectation. Remember, it is dealing with activist investors' starboard value, and it is dramatic over there. We're looking at Tesla also up more than 2% pre-market, up after an upgrade from Mizuho that cited an improved outlook under the Trump administration. Surprise, surprise, Katie.
Yeah, and still Tesla shares up about 2%. That's the micro. Let's talk about some of the macro here. All eyes on that Fed meeting tomorrow. But this morning, we got some retail sales data coming in hot on the headline level. Of course, if you peel out certain sectors, a little bit softer, but still on the headline, 0.7% increase driven by cars. Where is Matt Miller?
Yeah, no kidding. He's probably out there buying some of his own, I suppose. Do hogs count as cars? You know, it's interesting. Out of the sectors here, 7 of the 13 that you've seen categories posted increases. Mm-hmm. But if you stripped out autos, you did have retail sales a little lower than expected. So under the hood, a little bit of a muddy picture. Remember, the auto sector was something that was of grave concern just about a year ago. And you did see that cooling of interest rates, which did prop up that loan market for cars once again. Now, if you're buying all of this on credit, is it a good thing? Something to talk about.
Yeah, absolutely. And of course, BMO out with a note after the data saying this doesn't really change anything for tomorrow's Fed decision. But we know that consumers, we know that investors, and we know that policymakers concerned about sticky inflation. So let's keep this conversation going now with Alphasimplex Chief Research Strategist Kathryn Kaminski. And Katie, it's great to have you back with us. I'm taking a look at your note, and you talk about this short-term focus on the potential for Fed cuts and, of course, continued economic data into year-end. The Fed's 2-day meeting kicks off today. What do you think the hottest topic of discussion will be?
Well, I think the general consensus is that we're going to see cuts, but I think the market is much more focused on what's next. And that's why you see that today. So you see, for example, yields repricing, perhaps a less aggressive to cut Fed into next year. You also see that equities are perhaps seeing a little bit of a tailwind on that. And I think the biggest fun one to talk about this week is going to be the US dollar, which has been the biggest winner this month. So I think what we'll be talking about is how do you weigh the inflation data versus strong growth going forward?
Well, let's talk about equities, you know, from that bevy of asset classes. Equities are in an interesting spot right now because, of course, you have the equal weight rotation trade kind of sputtering out. Big tech is back in charge, and that's not what's supposed to happen. Seasonally speaking, I mean, December is a really good month for those small cap stocks. What do you make of the current trade and whether or not that will sustain into 2025?
That's a good point, because what we really have seen is a very narrow rally for the U.S. The U.S. has come out ahead this month but it's really on the back of tech, like you pointed out. And so I think one of the reasons this may be the case is just if you look at how much small cap rallied last month, there was really a lot of really big moves. So I think the question would be, if you don't see that type of pattern this month, is it a question that this pro-growth, pro-US narrative maybe isn't as strong as some people think? And I think that's something people will have to weigh as they're trying to digest the change in administration in the US and how pro-business and pro-growth the new policies may be for small cap.
It's interesting because if you think about the growth picture here, you look at the data just this morning, you're seeing yields back on the rise a little bit, not as much as we saw just last week. You have T. Rowe, the Chief Investment Officer of Fixed Income, writing that the 10-year may climb to 6% for the first time in more than 2 decades next year. What's your call on this, Katie? And what would that even mean if we reach levels that high?
Well, I think definitely that's exciting for someone who likes to short fixed, who has been follow short signals in fixed income. But I think right now our technical signals aren't showing that yet. We're seeing short signals in fixed income for the U.S. that suggest perhaps more of a slowdown. I think what their estimate is really pointing at is if inflation were to tick up, that could happen. But I think a lot of things would have to accelerate to see that type of move in fixed income. There'd just be a lot of buying pressure. So we'd have to have very strong inflation and strong growth to kind of get to a point where the bond market would want to price in long-term inflation and get us to 6.
It's interesting because, you are just under that 4.5% level. And we spoke yesterday to Max Kettner at HSBC, who called that a danger zone. If you start to see yields drift higher, maybe not 6%, but still higher, then what does that mean for equity investors ultimately and anyone who's taking on some risk right now?
Well, I think higher yields, it's tricky because as yields are higher, it has definitely a dampening effect on real estate. It has a dampening effect on borrowing for small companies. So I think there's just always that headwind of higher interest rates become a little bit of a slowdown for the economy. And we haven't seen that yet in GDP numbers, but I can see why a lot of times that sort of trigger point of having those rates going to a critical level could suggest that it might put pressure on companies and on individuals, slowing the economy down, which I think is the general concern.
Well, part of the conversation we were having with Max Kettner yesterday was not so much about the level, but he was also talking about the pace of the increase and the potential for disorder if we see a rapid rise. I mean, when you're evaluating the bond market, the relationship, the dynamic with other assets, particularly with equities, I mean, which should we be focusing on when it comes to tails and dogs?
This is a good question because honestly, the thing that I have really been surprised by this month, and this is something to point out, is that stock bond correlation has moved positive this month on the shorter time horizon, which generally happens when the market is more concerned about inflation instead of growth. And so I think if we start to see some acceleration in inflation data, I would actually look at the bond market because I think the bond market is where people tend to go to determine sort of what is the focus. And I think right now the bond market is really trading on, could inflation be higher? Could the Fed pause? And that's why I think right now those correlations are really something to watch and see if they accelerate.
What does this all mean in terms of where you find either a hedging strategy or diversification? Because if you're looking at the correlation turning positive once again, it breaks down that 60-40 once more. And we've seen that happen over the years is pretty significantly enough to worry. Commodities have been volatile. Do you look to gold? How do you find somewhere else to go?
This is a really good point because what we see when stocks and bonds are positively correlated, inflation drives the markets. You tend to see less hedging properties in fixed income, and fixed income tends to be more volatile, both things of which make our portfolios less diversified. So I think for investors, it's really about looking at other assets like commodities, which haven't really been easy this year, but might be under a case of more inflation, as well as looking at long short strategies and different approaches to diversify that classic stock bond exposure when the correlations deteriorate, become positive, and volatility in bonds is higher.
Katie, we thank you so much for joining us this morning. Of course, that is Alphasimplex, Katie Kaminski, helping us navigate these very choppy markets. We're going to look at some stocks moving ahead of the opening bell. We're going to bring in Abigail Doolittle.
Starting off with the shares of Affirm, which are down in the direction of the major indexes, also down about 3%. The digital payments company, they have brought out a private offering of $750 million in convertible senior notes. This is possible dilution in the future. Plus, the stock up 48% on the year. There's a 7% short interest, so it appears some investors taking chips off the table. Turning to one stock that is soaring, Solar Edge. However, on the year, down about 87% into today, and there's a 35% bearish short interest. We have a double upgrade from Goldman Sachs to buy. The firm is saying that the market is overplaying the risks around green energy with the new administration coming into office next month, and that Solar Edge is a buy. They create technology for solar panels. And then finally, Tesla. This is really pretty incredible. The stock now, Katie, up 80%, more than 80% on the year. You can remember earlier this year, it was a stock nobody wanted to take a look at. Today, we have an upgrade at Mizuho, another double one from outperform from neutral, an improving outlook under the Trump administration that will be taking, again, office next month. Essentially, the idea that there could be relaxed regulatory structure for those robo-taxis, the repeal of the tax credit for the other automakers, and you can see shares responding up 2.3%.
Absolutely. And incoming White House trade counselor Navarro was speaking on CNBC this morning saying that the Biden EV mandate will be gone under Trump. Investors taking that as good news for Tesla, or at least not bad news. As Abby said, of course, Tesla shares. But let's take a look at the broader market right now, because it's not too pretty of a picture. You have the S&P 500 down about 0.4%. I'm really interested by big tech right now. We know that the Nasdaq 100 has been on fire. It hit a record high yesterday. Broadcom, you can thank for that, even though NVIDIA has been a bit underwater. And that's exactly what we'll be talking about next. Broadcom shares have jumped nearly 40% in recent days as traders see an NVIDIA moment for the chipmaker. We'll have all the details after the break. This is Bloomberg.
And now to high interest, a look at what's making headlines around the world. Ukraine is claiming responsibility for the assassination of the head of Russia's nuclear defense force in a bomb explosion early today. The Russian general and his assistant died when an explosive device planted on a scooter detonated in Moscow. The killing of such a high-ranking officer in the Russian capital adds to spiraling tensions over the war as President-elect Trump returns to the White House next month. Yesterday, Trump told reporters that Ukraine should be ready to reach a deal to end the war. And the Federal Trade Commission is finalizing a rule that would ban so-called junk fees for live events, hotels, and vacation rentals. The rule would require businesses to disclose total prices upfront rather than tacking on extra costs like resort or convenience fees when consumers check out online. The rule would not stop businesses from charging fees, but they would be required to list prices clearly from the onset. And TikTok CEO met with President-elect Trump at Mar-a-Lago yesterday. This is just weeks before the popular video app is expected to be banned in the United States over national security concerns. Trump had previously tried to ban TikTok during his first term as president, but has since switched his stance on the app. Before the meeting yesterday, Trump suggested that he might try to reverse the ban to save TikTok, which he used to reach young voters on the campaign trail, Katie.
All right, so we'll keep an eye on that one and those 6-second videos. But let's talk about Broadcom, because shares are higher by nearly 38% over the past 2 days since it reported those strong earnings driven by AI optimism. Let's take a look at the share price compared to NVIDIA, because the chipmaker is showing investors that AI demand is so strong that there's plenty of room for leaders at the table. Bloomberg's Ryan Vlastelica reported on this, joins us now. And Ryan, compare what we heard from Broadcom last week in their latest earnings report to what we saw from NVIDIA in May 2023.
Hi, good morning. Thanks for having me. So yeah, we did talk to a lot of people for the story who basically said, is Broadcom kind of at that NVIDIA moment where people started to grasp the full scale of the AI tailwind, the kind of growth driver it would really represent for the company's products. And that's why we saw this just enormous rally in the stock last week. And people do see a lot of parallels between where it is now in the AI cycle and where NVIDIA was about a year and a half ago.
Well, draw out those parallels. You take a look at the stock chart right now and you see the catch-up trade, the 123, almost 124%. Broadcom has risen year to date, not quite NVIDIA levels, but getting closer. And if there are parallels, what does this mean for Broadcom's gains to come? Is it a sure shot upward, or are there serious risks to that story?
Yeah, that's a great question. I mean, obviously no one quite knows what's going to happen right yet, but the comments that Broadcom gave in its report, in its earnings call, where it talked about the growth kind of potential it sees from AI products, indicates that this is going to be a pretty long-term tailwind. And now, the way the AI spending has been working, as people build out their infrastructure, first you buy the NVIDIA chips to build out your data centers. Now people are buying Broadcom components to connect all those data centers. So this is sort of the next leg of AI spending. And the company is pretty optimistic about its growth potential from here. Now, we have seen a few other companies that have pretty pronounced AI tailwinds. Those stocks haven't done quite as well. Sometimes it's a valuation issue. Sometimes it's a execution issue. So we don't know which side Broadcom is going to go on yet. Obviously, NVIDIA is coming off an extremely strong year. Last year was extremely strong. But Broadcom, I think, is on track for its best, at least percentage gain in its history since it went public in 2009. So certainly a very strong year for them. Not quite NVIDIA levels yet, but so far no one has really been able to touch them.
Well, you mentioned valuation, so let's talk about it a little bit more, because you take a look at Broadcom, currently trading 38 times 12-month forward earnings. Pretty eye-popping figures there. And NVIDIA, at the same time, has been getting cheaper, at least by that measure. How are the investors and analysts that you're talking to thinking about the expensiveness of these stocks?
Yeah, so one thing that was interesting about NVIDIA is that it was growing so quickly and estimates were rising so rapidly that the stock was actually getting cheaper even though it kept rising. We're not quite seeing that with Broadcom. People are pushing up their estimates, just not to the degree that the stock is moving up. So the stock is getting a little bit more expensive. That does mean there's going to be a little bit of a higher bar. And to name another AI stock, we can look at ARM Holdings, which in February gave this very strong forecast. The stock was up, I think, about 50% in the immediate aftermath of that. It's sort of treaded water a little bit since then, just because that multiple is closer to 80 times forward earnings, so a much harder bar to clear, just harder to justify that kind of multiple. So that's kind of the two, maybe paths you could look at these stocks taking. Is Broadcom going to be growing rapidly enough that it's able to justify where the stock has already moved? That would be sort of the NVIDIA path. Or is it one where maybe it's just not able to meet these high expectations, and then the stock has to consolidate or pull back or just sort of tread water for a while, which is more of what we've seen with ARM, at least this year.
I'm glad you brought up ARM, because that's where I was going to go, just companies outside of Broadcom, because of the more than $410 billion in market cap that was lost by NVIDIA since its high. It's interesting. DataTrack points out that more than $300 billion of that market cap was kind of made up here by the gains you saw in Broadcom. You had another nearly $30 billion in market cap added at Marvell. Are investors just looking for trades outside of NVIDIA right now to capitalize on, given the run-up we've seen, and who are the biggest beneficiaries?
Yeah, it wouldn't surprise me if the idea was, everyone knows about NVIDIA, everyone is aware of these tailwinds. What is going to be the next kind of company to benefit? One that's maybe trading at a lower multiple or just earlier in the cycle. Even outside of the chip space, you've seen just enormous gains in a stock like Palantir this year, because that is a very AI-focused software stock. So you are seeing people looking elsewhere, but obviously AI remains sort of the central theme for tech investors, if nothing else.
Ryan, we thank you so much for joining us this morning. That is Bloomberg's Ryan Blastelica. We thank you for your reporting. And coming up later this hour, we're going to talk tech opportunities with Kristin Roth DeClark. She is the global head of technology investment banking at Barclays. And in the next hour, we're going to talk about the real estate angle of AI and data centers and more with Blackstone's Nadeem Meghji, who has made this a key focus for him and his team. That's all ahead on Open Interest. Stick with us. This is Bloomberg.
All right, minutes away from the opening bell. This is your setup heading into the Tuesday cash trade. You can see we're on a down note for the S&P 500, for the NASDAQ 100, for your small caps as well. Big tech has been doing all the heavy lifting in this market, but that momentum breaking a bit today. You can see the Nasdaq 100 down about 0.3%, actually resilient when you take a look at the other big benchmarks. The S&P 500 down about 0.4%. We're still above 6,000, so that's the good news. The Russell 2000 really struggling with this rise in rates that we've been seeing. Of course, currently down about 0.4%. We know that the Fed's two-day meeting kicks off. We know that the fiscal has been the topic of conversation in these markets, but at least for right now, at least for a day, as Abigail Doolittle said in her morning note, of course, Jerome Powell is going to take over, and we'll see if he can put some life back into these markets, Sonali, because it's certainly been an uneventful start, of course, to the final full trading week of the year.
Yeah, certainly uneventful, but very interesting as well, because you do see single stock movers that have been moving the market to the point you've been making yesterday, that you did see, yes, Nvidia still entering correction territory, but Broadcom having made up for some of those gains. Maybe not as much today, though. You are seeing all the indexes lower, but you are seeing some life here in other stocks. Pfizer up on the heels of lifting its guidance. You have Burla also talking about his meeting with Donald Trump in Mar-a-Lago, him and many other CEOs, and Tesla also higher as well, expected to gain from that Trump trade. But coming up, Katie, we're less than 4 minutes to the opening bell. We're going to discuss the market moves with Stephanie Guild of Robinhood. We're going to talk about what's moving under the hood. This is Bloomberg.
All right, we are moments away from the start of trading on this Tuesday morning. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. You take a look at the averages right now in the pre-market just seconds to go, giving up some of the gains that we put in place yesterday across all the benchmarks right now. But nevertheless, the bells are ringing. You have people clapping over at the New York Stock Exchange, down at the Nasdaq as well, of course. There's plenty to look forward to this week, the final full trading week of the year. We've got the Fed, we've got earnings, we've got economic data, retail sales coming in hot this morning. But you take a look at how it's translating all together into the major benchmarks right now. None too pretty. The S&P 500, of course, it was higher by about 0.4% yesterday. You can see that it's now down 0.4% just in the first 22 seconds of trading. The Nasdaq 100, a big day yesterday that was led by Broadcom's 11% advance. Taking a bit of a breather right now. The Russell 2000, the little guys are your biggest loser at the moment, with the small cap index down about 0.6%. That is the picture at the benchmark level. Let's take a look under the hood, because we have to talk about Nvidia testing levels not seen since August as it drops near $130 per share. The stock has fallen 5% in recent days and officially fell into correction territory on Monday. This, of course, is the flip side of that Broadcom story that we've been talking about this morning, Sonali.
Yeah, super fascinating to see the year's most beloved stock finally getting a breather, but love maybe elsewhere, including in Tesla. You're watching Tesla shares climb on a Mizuho upgrade. Analysts are bullish on autonomous regulatory frameworks under the incoming Trump administration, and Mizuho's price target is now $515. We're at $471 right now. Finally, Pfizer is higher after forecasting 2025 sales in line with expectations as it deals with activist investor Starboard Value. That is a drama we can't keep our eyes off of. We're going to get a closer look at Pfizer now with Bloomberg's Abigail Doolittle.
Yeah, and this gain, Sonali, comes within a decline since the election, down about 7%. Some concerns perhaps around their vaccine practice. But interestingly, CEO Albert Bourla did just recently say within this update that after his dinner with President-elect Trump, that the attitude may not be as negative toward vaccines as expected. And he also said that Trump is very committed to PBM reform on this, the shares of CVS dropping. Now, you can see that spike higher. And if we take a look at the earnings for the year, essentially the street very positive about this. We're looking at $2.90 for this year and then $3 for next year. The street is saying that the midpoint is above where the street had expected. BMO saying that it's reasonable yet achievable. Citi saying the guidance is in line with the sell side, but not the buy side. That's a positive, clearly, since the buy side might be encouraged to buy, and that there could even be more upside on the year. Let's put it all into perspective, because we have the shares of Pfizer down on the year. You can see in orange Pfizer, and then Johnson & Johnson, Bristol Myers Squibb, and AbbVie. So Pfizer does have its work cut out for it in 2025 to catch up with some of its pharmaceutical peers, Katie.
Yeah, absolutely. Some good news for Pfizer today, but that's certainly a deep hole to climb out of. Our thanks to Abigail Doolittle. Let's broaden out this conversation now, because sitting to my left, we have Robinhood's head of investment strategy, Stephanie Guild. She joins us now. Great to see you in person.
Yeah, likewise.
So let's talk about this rotation trade and maybe saying it goodbye, because it's been interesting to watch the Magnificent Seven lead the S&P 500 equal weight by the most on a monthly basis since May 2023. And we were talking in the commercial break how it's a bit curious to see big tech take back over. What do you make of this dynamic and whether or not you think it'll last?
I think a couple things. When I first started rallying, post-election, we had the small cap rally, we had Bitcoin rally, we had a lot of things rally in favor of the election, and I thought that was going to kind of continue. It was the start of this broadening. I still think that is possible, but we did have the 10-year kind of come off the boil and drop quite a bit, and so I thought, oh, that's sort of why these growth stocks are rallying. They're longer duration stocks. But now that we have the 10-year kind of coming up, I'm starting to wonder. And I'm not sure why, because there's really no data that supports this yet. Are the markets starting to be worried about growth? And are they just looking for places for maybe more sure growth that if they think the economy is not going to be there for it?
It's interesting. I mean, Neil Dutta had a note out this morning talking about how he's on the cautious side of the growth outlook. And even still, I mean, you're seeing this rise in the long end of the Treasury curve. You think that if you were worried about that investors would be buying bonds. But is it possible that it's the big tech names that have turned into sort of the haven trade here?
Yeah, I think it's absolutely possible. And I think the 10-year has another factor that it maybe hasn't had in a long time in history, or possibly ever, and it is our deficit. They are debating pushing the debt ceiling out. It's going to expire December 20th. And it maybe starts to show that things aren't going to be as easy as perhaps the euphoria might have expected post-election.
Speaking of euphoria, I am very excited to see what Robinhood's own customers, the retail crowd, is doing about some of the moves that you're seeing of late in markets. How are they trading December? Are they buying into that MicroStrategy story with the NASDAQ 100? Are they selling NVIDIA with the wave?
You did see, so during the month of November, you saw them take some profits in the names that had done them the best. Tesla, for example. And then putting that money into, on the margin, places like NVIDIA and Amazon. Since that time, you have started to see them take some profits there. MicroStrategy has been the place that has defied the typical behavior of our customer, which is to trade around the shifts in their core positions, and haven't really seen them, despite the rally in the name, take many profits. I'd just say in the last more recent time period, I've started to see a little bit of it.
Is that because they're already overexposed, do you think? Or is that because they're saying, hey, why would we buy MicroStrategy when we can just buy Bitcoin?
I think they're doing both. It's what we're seeing from our activity. And I think our customers, they do tend to take a long-term view in core positions. And you've seen that in the electric vehicle space and Tesla for sure. But you've also seen, Bitcoin is another place, I would say, that it's sort of like if you're in the camp that you believe Bitcoin has a long-lasting place in the markets, then you stick to it. And I think there is a paradigm shift post-election. I think that more and more of the institutional players are going to start using it as another tool in their toolbox in terms of asset allocation.
Yeah, and it's interesting. You had Trump's embrace of crypto seemingly on the campaign trail, but certainly some of his picks to top government positions have been backing that up. I actually want to go back to the deficit and the Robinhood crowd. I mean, what we're talking about, these concerns that maybe we're starting to see in the bond market about the deficit, you could make the case that you're seeing some of that in certain places of the stock market. Is any of that reflected in your Robinhood customer activity, or does that not exactly make it onto the radar?
I don't think it makes it onto the radar because we haven't seen much of a shift in the types of companies that they invest in and trade in. But I'm not sure that there's that much of a connection between the types of things that they invest and trade in and the deficit, because they are investing overall in growthier companies. And if they tend to grow, that typically can happen despite what's happening in the government.
I want to go back to what you were saying earlier about these growth concerns as well, because you saw retail sales this morning. Presumably the Robinhood customer is the same one that's going out and spending in a store or buying a car, right? And so if you're seeing kind of strong retail sales, but it was choppy, but you're seeing an animal spirit plateauing in the market, what does this mean on aggregate? Do you think they head into 2024 with, guns blazing here and ready to put more money in? Or do they say, okay, well, wait a minute, we're a little maxed out and it's time to take note of those worries?
I think overall it's healthy to take note of those worries, and I do think you're seeing that here. I strongly believe that expectations are everything when it comes to the market. And there was a lot of expectations that have been built into the market, especially post-election. And it makes sense to kind of see a little bit of like a tempering. And in particular, there may be an aspect to this market where people are going to wait to take some gains. I wouldn't be that surprised if we have a little bit of a correction sometime early next year. But I don't think it necessarily means that it's the beginning of a new trend where there's softness in the economy and the market. I truly believe, and I put out my outlook last week, that we're going to continue with this soft landing, like positive growth story. But there is more uncertainty now, because I think initially post-election there's a honeymoon about all the positives that come from a new administration, but there also are some uncertainties when it comes to things like taxes and tariffs and even immigration that can affect the economy. And I think that's starting to be realized now.
Well, that's where I'd love to end with you, and we only have just a minute left, but you think about expectations for 2025 and this tug of war between monetary and the fiscal. Who's in the driver's seat?
I think for me, it's more fiscal than monetary, because, I think next year is going to mostly be a market where the Fed cuts a couple of times, and then, it doesn't create the waves that it has over the last couple of years. I definitely think it's going to be more of a deficit issue.
Stephanie, thanks for coming in this morning. We really appreciate your time. That is Robinhood, Stephanie Guild. And coming up, swiping right is so last year. Users are in love with prompt dating, and it's messing with Wall Street's Tinder romance. We're going to give you details and top calls next. This is Bloomberg.
This is Bloomberg Open Interest. I'm Abigail Doolittle in the principal room. Coming up, an interview with Blackstone's global co-head of real estate. That's at 10 a.m. Eastern. This is Bloomberg.
All right, welcome back to Bloomberg Open Interest. You're taking a look at the stock market right now, about 13 minutes into the trading action. You can see the S&P 500 down about 0.4%. We were higher by 0.4% yesterday, so it's early, but we're flat on this week. The Nasdaq 100, though, after a big day yesterday, 1.5% higher. Taking back some of that right now, down about 0.4%. The Russell 2000 is your biggest loser at this moment, down about 0.5%. It's time now for our top calls, though. Some of the analyst action in focus this morning, and we start with Brown-Forman getting downgraded to sell at JP Morgan. The analyst says that tariff risks could be a double whammy for the spirits maker, currently down about 0.9%. Next up, we have Mizuho upgrading Tesla to a buy, citing an improved outlook under the new administration. Big surprise there. The analyst says that Trump's policies, namely the repeal of a consumer EV tax credit, gives Tesla an advantage over its peers because of its lower EV cost structure. Shares up another 2.3%. And finally, Jefferies saying that Match no longer a buy. The firm is downgrading the online dating app to a hold after the company's Investor Day event, where it warned about revenue trends for its Tinder app. Match Group says that there has been a consumer shift away from swipes to prompt dating, where users engage with prompts or questions to spark conversations. You learn something new every day. Match shares down about 1.6%. Now, coming up, deal makers expect a second Trump presidency to boost deal activity. We'll talk M&A with Kristin Roth DeClark, Barclays Global Head of Technology Investment Banking, next in our Wall Street Beat. This is Bloomberg.
And it's time now for the Wall Street Beat. Deal making bounced back this year. Global transactions have hit $3.1 trillion. Now, bankers are optimistic that Trump's second term will turbocharge the recovery in M&A. Joining us now is Kristin Roth DeClark, Global Head of Technology Investment Banking at Barclays. And, you know, one question I have is you've seen CEO after CEO go to Mar-a-Lago over the past week, many more coming. And does that mean that it's a sure shot that those big tech companies won't be clamped down upon next year?
I think that investors are broadly expecting a less restrictive regulatory environment under the new administration, and for that reason expecting a tremendous surge in M&A activity going into 2025.
So what is happening under the surface for your industry? You have all of these tech companies. The IPO window is just starting to reopen. A lot of success there, but you haven't seen those big tech players really come to the fore for many months. Do they go public or do they sell?
I think there's more conversations around going public. I actually think 2025 will be a busy IPO year. One, because the performance of the IPOs that in 2024, while there were only 8 tech IPOs, they're trading up over 100% on average. And companies are now looking at going public for the reason of having acquisition currency. It's less about providing liquidity for employees because the secondary market continues to be very strong. But they're, especially with increasing M&A activity and potentially a less restrictive regulatory environment, more ambition to get public to have that currency.
That's really interesting. Let's fold valuations into that, because if you do see this wave of tech IPOs come to the market in 2025, I mean, would you expect them to be valued, especially to some of their more recent private funding rounds?
Yeah, so 2020 and 2021 were a kind of a moment in time as it relates to valuation paradigm. We're at a new valuation paradigm today, and I think investors expect that, companies understand that. Over a third of the tech IPOs this year went public at valuations that were lower than their last private round and have transcended that now in the public markets. And so there really is no stigma associated with going public at a lower valuation than your last private round.
That's interesting. Is that a change, the fact that there isn't that stigma, or have people accepted that maybe we were in silly season in like 2021? Yeah,
I think it's really just things were so unique that time in 2020, 2021 relative to history as it relates to valuation, that it's just an expectation today that we have a new framework.
So what does this mean in terms of the types of companies going public? Because of course the topic of the day has been AI, but if you don't have that kind of AI tag to you, can you make it public as easily, realistically? Do you think that is a necessity almost if you're a technology company today?
I think every company has to articulate their AI strategy in some way, but it can show up in different ways. In some ways, in some enterprise businesses, it's showing up more in margin improvement because they're using AI to improve efficiencies. In some consumer-facing tech businesses, it's showing up more in the user experience and adoption of that platform or technology.
So let's also talk about M&A. In addition to the IPO market, obviously the two are related, but you are starting to see M&A come back. You have all this optimism, as Sonali walked us through. I'm wondering about deal sizes, though, because it seems like we haven't seen a lot of really big mega deals, double-digit billions. What's your expectation when it comes to actual sizing?
It's pretty awesome because we're starting to have these conversations with companies about these mega M&A deals. And I think post-election, that level of kind of moving from conversation to potentially action has increased pretty significantly. So I do expect we'll see 30, 40, potentially $50 billion type deals at least announced at some point during 2025, just given the level of conversation with some of our clients.
One question I have is, these are large deals, as you've been talking about, but why not wait a minute? I mean, valuations are near all-time highs. The NASDAQ 100 has been on a tear, and you're talking about a dynamic that could create a lot of competition. If people are trying to go public, then wouldn't that make the premiums much higher if you're trying to buy?
Look, I think that both M&A and the equity market kind of work in concert in some ways. If there's a bid for essentially companies that are public to do take privates, if there are subsidiary IPOs or carve-outs of existing public companies going to M&A, going to other buyers, both of those kind of feed on each other. And so I expect that along with the more healthy M&A environment, will also bring along a more healthy IPO market.
What is that like for the private equity firms as well? Because if you're now third element of competition, right? They have tons of dry powder on the side. Financing markets have been open. Leverage loans have been booming once again. Are they ready also to play in these maybe competitive situations?
Yeah, and I think we'll see, well, first of all, we'll see, I think, increased activity around take privates because the financing environment is such that it makes it more attractive. The second piece is we'll see more private equity firms taking companies public to try to return capital to LPs. And there just haven't been as many sponsor-backed IPOs over the last couple of years, or the same cadence of returning capital to LPs as we've seen in previous years. So I do think there's more pressure to get some of those assets off of their books.
And I do want to zoom out because one of the big stories on the terminal this morning is that deal makers awaiting Trump after bouncing back with $3 trillion haul. We've been talking about, this optimism, there's this enthusiasm, and it does seem like things are unlocking both in the IPO market and in the M&A market. Do you worry, though, that we're getting a little ahead of ourselves, that we're getting a little over our skis, and that the potential for disappointment is pretty high right now?
I think a lot of it remains to be seen post January 20th, and in the way that the priorities of the next administration are messaged. But there is a lot of optimism today. So if it doesn't follow that, of course, you could see at least a short-term correction. But I think longer-term investors have confidence that there will be a less restrictive regulatory environment, which should increase deal-making activity.
Yeah, you think about the wave of risks out there. What's the one thing you think that could stop the party?
Well, I think some of the geopolitical threats that we aren't aware of, right? I mean, we're in a very different place today than we were a year ago. We came into 2024 expecting 7 to 8 rate cuts in 2024 expecting 7 to 8 rate cuts. We came in with a looming election. We now have the election behind us. We have more modest expectations around interest rate cuts going into 2025. Markets pricing in 2 or 3. But there are always geopolitical uncertainties that are hard to forecast.
All right, Kristin, it is great to get some time with you. Hope to see you again in 2025. That is Kristin Roth DeClark of Barclays. Meanwhile, let's get a check on these stocks right now. We are about 25 minutes into the U.S. trading day. You can see we're on a down note right now across all index levels. The S&P 500, the NASDAQ 100, the small caps, all in the red today after a pretty good day yesterday. What's interesting to me, though, is that if you take a look at volume right now, Sonali, we're actually above our 20-day average on the S&P 500, about 21% higher on trading volume right now. And I guess it makes sense. It's December 17th.
Profit taking.
Well, profit taking, and also if you have a trade to make, if you have windows to address ahead of year end, this is probably the week to do it.
Those window adjusting trades might be the most popular ones out there at this moment. But of course, the big day is still tomorrow. Excited to see if that shakes things up a little bit.
Exactly. Not so much on the decision tomorrow. We know they're going to cut rates, but what are they going to do in 2025? What will the dots say? Maybe Linda Duessel will have some answers for us. She'll be joining us at the top of the hour. She says that there's evidence of fatigue in markets right now. And then we're joined by Blackstone's co-head of real estate joining us. Really looking forward to that conversation. Of course, that big call out of T. Rowe that, maybe we'll see 6% 10-year Treasury yields. That would certainly have implications for real estate. And then we'll be joined by the CEO of Sysco. We're going to be talking about food inflation. We'll be talking about tariffs. All of that and more coming up. Don't go anywhere. This is Bloomberg. Minutes into the Tuesday trading day. Welcome to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today. And coming up, fresh retail data suggests that consumers remain resilient as investors await the final Fed decision of the year. And as that Fed decision looms, we're going to find out how the world's largest commercial property owner is navigating this rate environment. Nadeem Meghji, Blackstone's global co-head of real estate, joins us this hour. Plus, economists have raised their projections for U.S. inflation next year due to tariff concerns. We're going to discuss that and more with the CEO of food distribution giant Sysco, Katie.
All that and more coming up. Let's get a check on these markets right now. You can see pretty soggy. The S&P 500 down about 0.4%. We're just about flat on this week. You take a look at the Nasdaq 100. Big tech has been your leader for several weeks now. Currently your leader to the downside. The Nasdaq 100 off by about 0.5%. The bond market well behaved, at least for this exact moment. Your 10-year Treasury yield pretty much unchanged, but we're trading just below 440. We know that we've seen quite a climb in long end yields. Have to wonder what tomorrow's Fed meeting will deliver to the bond market. But we did get retail data earlier this morning ahead of tomorrow's Fed rate decision. Let's break the numbers down now with Bloomberg International Economics and Policy correspondent Mike McKee. And I know there's a lot of focus on auto sales, but 7 of the 13 categories actually posted increases here. So what were some of your main takeaways?
Well, in general, it showed consumers are still outspending. It was an auto story. We were up 0.7 on the month, and retail sales for October, 0.5 revised higher. And car sales led the way, thanks to Sonali and her new car that she's been telling us about. Retail control, though, is what you want to watch, and that's what goes into GDP. That rebounded nicely from a decline in October. And we got some business numbers, too. Business manufacturing numbers. Industrial production overall down because mining and utilities were down, but factories produced more, up 0.2%. The combination tells you that the economy hasn't fallen off a cliff, and it's one more element for the Fed to consider as they work. Now, about that retail control number, the big question is, are consumers going to continue to spend, and what does that mean for growth? As you can see, last year at this time, on the left-hand side of this chart, people stopped spending in November, and then you could see the big jump in December. So the fact that we had a reasonably good number in November raises questions about how good December could be. Could it be a blowout December, or have people already spent a lot of money? Remember, Cyber Monday was in December this year. We also had, as Sonali mentioned, some new economic forecasts. Bloomberg surveys economists around the country, and they basically see the first quarter growth a little bit higher, and everything else more or less unchanged. But they do cut back on what the Fed thinks is going to what they think the Fed is going to do. One less rate cut before the end of the first quarter. These are first quarter numbers. As you can see, GDP revised up a little bit, but unemployment and PCE headline inflation unchanged.
So what does this mean for the Fed at the end of the day? It's time to talk about it. Tomorrow's the big day, but as Katie has been mentioning also, it's not just the cut, it's all the other things around it and what they see into the future. What would shock investors if their crystal ball doesn't align with what investors are currently expecting?
Well, I think most investors are in the somewhat 2 to 3 category for rate cuts next year. Anything less than that would be something of a shock to the markets, because they would not only wonder where the economy is and how far inflation is from getting down, but they would worry about how Donald Trump would react to that as president. If we got 4 or 5 rate cuts next year, people would wonder, is the economy really weak? So I think they want to come in that 2-3 area. But I think this is going to be an economic projection that's going to have one of those dates stamped on it, like food. Expires such and such a day. Yeah, Best by January 20th, and then we'll see what happens going forward.
I would say Best by December 31st. No, I don't know. We'll see. Michael McKee, we thank you so much for your time. We're going to bring in now Linda Duessel, Senior Equity Strategist at Federated Hermes. Let's talk about that expiration date, actually, because if you look through the Fed's tea leaves and try to project out into next year, how difficult is that when you have a new president coming into office and a lot on the agenda for Congress and a lot of concerns about the direction ahead?
Well, good morning. Thank you so much for having me on your program today. It's difficult because President-elect Trump has a lot of policies that he's announcing he wants to have accomplished, and we don't know how much of them will be accomplished, and we don't know the inflationary impact of them. So this is why it would make a lot of sense for the Fed to pause and stay on hold and say, really, I mean, this is going to be a big year for data, and we should really be dependent on it.
Do you think that they will, though? I mean, of course, we talk about how the Fed can't control the fiscal side of things. They don't make policy in anticipation of what's going to happen on the fiscal side, but they're also not making policy in a vacuum. And it just seems like a pretty difficult needle to thread for Jerome Powell and crew to try to sort of operate around what's going to be happening on the fiscal side.
Yeah, sure. I mean, they have a tough time always because they have to try and figure out, are we trying to stave off inflation or are we trying to stave off a recession? And what we have seen throughout this year is, as you said, a resilient consumer, but the unemployment rate is creeping up and the job opening rate has come down really to normalized levels. Will we stay at these normalized levels or will it continue to get worse? And that's the thing, you just don't know about the employment situation because it can be benign and then it can spike. That's on the one hand. And on the other hand is, will inflation surge again? And inflation often does look stronger in the first part of the year. So it could be a kind of a scare going into the beginning of the year. The first 3 months is often when you get the biggest piece of your inflation for the year. So Fed has to weigh both of those. That's why a pause might be in order next time around.
When you listen to the chorus of the market, there has certainly been a lot of exuberance out there, but more and more you do hear this concern coming up that, okay, maybe employment can start to stall out. Maybe productivity becomes a bigger issue. I mean, at the end of the day, to the extent you're worried about things weakening from here, what would give you that kind of evidence to be cautious, to be a little bit concerned?
Well, to be cautious and concerned, I would look to see what's going on with the wage growth year over year. And we like the Atlanta Fed wage growth figures, which showed pretty much a sharp decline. I mean, you were in the 4.5% year over year increase. This is for job to job, like job to follow people around. And now you're down to 3.9%, but really fell sharply in the lower income cohort. So there is potential evidence there of a continuing weakening of the job market. And as soon as that happens, we stop buying things, and then you really do seem to fall into recession. On the one hand. On the other hand, if I may, for me, the most powerful thing that I've heard lately is from the NFIB and their Small Business Optimism Index, where they're at record high on optimism, and they surged in terms of, is this a good time to expand your business? The surge in multi-year highs suggests that maybe there will be hiring to surprise on the upside next year.
Yeah, and I believe you're able to break that down by political affiliation, that optimism that you speak about. And it's pretty interesting to see that sort of breakdown there. But Linda, I want to bring this conversation more directly to the markets and specifically the equity markets, because there's been several notes on what positioning looks like. Of course, you have the household sector stock ownership at a record 39%. There was a Bank of America note out this morning, a fund manager survey talking about how allocation to U.S. equities is at a record high of 36% overweight. People usually trot that out as a reason to be concerned, but how are you thinking about positioning right now?
Well, it's been a narrow market, and it's been an exuberant market. We had been reading that flows have slowed down here, though, recently. And when you look at what's going on in the market overall here, kind of the rotation, which has been really strong in these past few weeks, where many stocks are off their highs now and in correction territory, and that goes to the small cap sectors, small cap stocks, some of the cyclical sectors, and where now the top 10 names represent 39%, an all-time record high by a lot. That kind of breadth is not good. And to see the breadth as slowing down, to see the number of declining versus advancing stocks now for 11 straight days, 12 straight days of negative breadth, if it happens today, will be the worst second worst in 100 years. So that is a very kind of a narrow market. Maybe people taking money off the table because it's been so strong so quickly after the election. So the jury definitely is out on that one. And then you'll have increasingly less volume in the market as we make our way in through the end of the year.
Linda, we have to leave it there. We thank you so much for your time. That is Linda Duessel of Federated Hermes. Now, coming up, we're going to discuss how the interest rate environment will impact commercial real estate. We're going to bring in Blackstone's global co-head of real estate. Stick with us for that conversation. It's up next. This is Bloomberg. U.S. office values may finally be finding some support, and according to the latest research from Bloomberg Intelligence, prices may be finally reaching a bottom from their 2022 high as the Fed shifts to a more dovish stance. Joining us now, Nadeem Meghji, Blackstone's global co-head of real estate, who has been talking about that bottoming for a while. Remember, Blackstone is the largest owner of commercial real estate globally. And what's the math look like here? You saw a series of rate cuts starting here, another one expected tomorrow, but an expectation that you start to see a moderation of that decline. So what does one additional rate cut really amount to for someone like you?
Well, if you take a step back, and first of all, thanks for having me on today. We went through 2 years, 22 and 23, where rates went up quickly, and that created a negative impact on real estate values. And add to that, we had challenges in office. That was another big headwind. What we said publicly, and you alluded to this, at the beginning of this year was that what we saw happening was commercial real estate values were bottoming. And what we've seen since that time is 3 straight quarters with private market values in real estate appreciating. Now, not a V-shaped recovery, still some challenges in office. But what's driving this recovery is really 2 things. One is a lower cost of capital. Part of that is base rates. You talked about the Fed cutting rates. Part of that is spreads, what banks will charge. And as a result, we see much more liquidity. We see those animal spirits coming back, more people bidding on assets. And then the second thing is a higher rate environment has led to less new construction, down 60 to 80% in our core sectors. So as we take a step back, putting aside what happens in any individual Fed meeting, we see the path of travel on rates continuing to moderate, rates continuing to come down in a deliberate fashion. But really, if you look at what that means for real estate, if you invested in real estate in the 90s post-SNL, you made money. If you invested post-GFC, you did really well. We think this is one of those moments, which is why we've been so aggressive.
Well, speaking of aggression, it's interesting. Are you buying or selling more? We had a story out on the Bloomberg terminal about your eyeing a sale of a resort in Hawaii that you bought for about $1.1 billion in 2018. How many sales are you looking at right now? Are you looking to capitalize on those animal spirits? And are these the moments that Blackstone is looking to capture the profits on the assets bought over the last 5-6 years?
Certainly, the environment is improving. When you think about sale activity and you think about values, when there are more folks who want to buy real estate, that's usually a better time to start selling. And so we expect to see even more of that next year. But if you look at this past 12 months, we've deployed nearly $30 billion of equity capital around the world, investing before we see the all clear sign, before it becomes obvious to the rest of the market. One of the things that we see is that the S&P 500 is traded back up to near all-time highs. Corporate bond spreads are near all-time tights. But real estate, this $20 trillion asset class, is still relatively cheap. You can still buy assets well below replacement cost. That is why we've been so aggressive deploying capital over the past year.
Well, let's talk about what you're buying and what you might buy more of. You mentioned office, and the narrative for so long has been CRE looks great, except for office. Blackstone, of course, recently bought a $2.6 billion Tokyo office complex. Do you have plans to buy more offices? And if so, what sort of regions and geographies are you looking at?
Sure. If you take a step back, office was an asset class that we had actually underweighted before the pandemic. And the reason we did that is that we saw CapEx was growing faster than rents. And then, of course, the pandemic happened, and that put a lot of pressure on the asset class. As we've now emerged from that moment, there are some tailwinds we're beginning to see. Companies like Amazon announcing that they're back in the office 5 days a week. That'll happen at the beginning of next year. And then there are submarkets that are actually outperforming today, especially those that cater to financial services. I think about Park Avenue, where Blackstone office is. We just signed a 1 million square foot lease. Vacancy on Park Avenue is 7%. That's half of what it was 2 years ago. So you see this bifurcation where better buildings are doing better, better submarkets are doing better. We are now dipping our toe back in very selectively. We definitely don't think office is going away, but you have to be very selective.
It's interesting because Blackstone has obviously been very excited. You're really emanating that here today. But I do want to recognize that there are parts of the interest rate market that have really been choppy. The 10-year has been all over the place. It has been flirting its way back to 4.5%. What does this mean for lenders? You think about BXMT in particular, had to cut the dividend a little bit earlier this year. What does this mean in terms of the ability to weather the storm in that market?
Well, I'd say two things. One is, broadly speaking, when you think about the impact of interest rates on asset values, it's not just base rates, it's also spreads, as I was describing earlier. And so the all-in cost of borrowing today, for example, if I was to buy a warehouse in the US, is down around 35% relative to what that would have been a year and a half ago. And that's because credit spreads have fallen by around 50%. So that combined with more leverage being available has really resulted in a lot of support for this recovery in asset values. As it relates to BXMT, this is a business that has tremendous momentum. The worst of our credit challenges are now behind us. We're seeing $1 billion of repayments this quarter, $4.5 billion of repayments so far this year. That gives us dry powder to play offense, to invest into a really attractive environment. And I think the market's beginning to recognize that. We actually just did our biggest corporate debt offering of all time, and it was 4 times oversubscribed. We feel very good about where we're heading there.
Let's talk about another area where I have to assume you feel great about, and that is data centers. We talk about AI in pretty much every conversation, and let's wrap it into this one. Of course, Blackstone, the largest data center provider in the world. I mean, how big could this sort of industry, could this market get? Obviously, you're already a heavy hitter here, but what is the sort of pie in the sky projection that you have?
Sure. I mean, it's big, and we think it could get a lot bigger. When we think about the thesis here, if you believe in the digitization of the economy, migration to the cloud, AI, that's going to drive demand for data centers. Everything we do on our phones ultimately happens inside a data center. And today, if you look at our business, we're the largest owner and developer in the world. $70 billion of data centers that we currently own or are building, and a land bank that can support another $100 billion. We bought QTS data centers in the US 3 years ago for $10 billion. We've grown that company 8-fold. Now, if the question is, how big can this get and where are we heading? One image on OpenAI requires 300 times the compute of a Google search. If you want to create a 1-minute video using Sora, 10,000 times the compute of a Google search. If you talk to the major tech companies, they would say they're going to spend $1.5 trillion on their digital infrastructure over only in the next 5 years. That's going to drive demand for data centers.
Nadeem, we only have a minute left, but you bring up QTS, and Bloomberg had a big take story on this last week, talking about Fayetteville, Georgia, and sort of the controversy that's caused, the data, the power lines causing, a bit of stir in the community. And I'm curious, I mean, how do you think about that, about the different communities and towns where some of these big infrastructure needs for these data centers are going?
Yeah, well, if you take a step back, why are we building these data centers? It's because every time you go to the doctor, they pull your medical records. They're pulling that from a data center. It's important for our country. It's important for productivity, for all of our lives. When we build in individual communities, we're really focused on what is that net economic benefit. We're creating thousands of construction jobs. We're creating permanent jobs. We're adding tax revenues that support important local priorities. Housing, schools, roads. We're reducing the tax burden on families. We also, each situation is different, really work hard to ensure that we're creating win-wins with the communities in which we invest and operate. And that's why in most cases we're being invited by electeds to invest in these individual cities.
Nadeem, we have to leave it there. Thank you so much for coming in to help close out the year with us. That is Nadeem Meghji of Blackstone. And a little birdie says their holiday video is coming out this week. We'll be keeping an eye on that. Stick with us. More markets up ahead. This is Bloomberg.
All right, it's time now for Social Climbers, the companies making waves this morning. And first up, a spicy deal may be in the works. McCormick, it's the owner of French's Yellow Mustard, as well as Frank's Red Hot, in talks to buy Sour Brands, which of course is the parent of Duke's Mayonnaise. That deal could value the company at more than $1 billion, but both companies not commenting on the news. And next, we have the union representing Starbucks baristas voting to authorize a strike ahead of final bargaining. No decision has been made on whether or not the workers would strike, but the labor group said that the company has yet to bring a comprehensive economic package to the bargaining table. Starbucks also not commenting, Sonali.
And coming up, we're going to talk about inflation continuing to rise in a number of food categories. With that, we're going to talk to the CEO of food distribution giant Sysco. Next, we're going to talk about cocoa and coffee and all the things you love to buy. This is Bloomberg.
Well, from coffee to cattle to cocoa, it feels like the price of everything is getting higher right now. And that's a real problem for large food manufacturers, including for Kevin Hourican. He is the CEO of Sysco. He is a food distribution company that services restaurants, educational facilities, and hospitals around the world. So, Kevin, you have a really unique view into some of these supply constraints that are impacting different parts of the commodity world. And I'm curious about how you at Sysco are handling a market and different parts of that market, from cattle all the way to coffee. What does that mean for Sysco?
Katie, good morning. It's a pleasure to be with you on the show and with your audience, today. To understand inflation and where we are at the spot moment, I think it's helpful to just take a quick step back over the past, couple of years. As you just said, we're in what's called the food away from home business, so everything outside of the grocery store, restaurants, hospitals, education facilities, sports venues, and the like. Coming out of COVID, demand was far outpacing supply. We saw significantly increased inflation. In fact, it peaked at about 18% a couple of years ago, again, with demand far outpacing the ability of producers to supply product. We followed that with deflation, actually, where the costs were coming down, and we've settled at about 2%. So at the spot moment today, inflation, COGS increase inbound to Sysco is at about 2%, which is in a reasonably normal status. And that's across all categories. But that doesn't mean that there aren't individual categories like chicken, as an example, where we're seeing elevated inflation because of, again, lack of supply versus demand. So we're seeing a bit of a normal environment at the current moment. The challenge that consumers are facing is the following, Katie. If you look back cumulatively over the past 2 to 3 years, menu prices, when we go to a restaurant, are up about 30 to 40% versus 2019. So I think that's the pain that we're all feeling when we go to a restaurant. We at Sysco are taking actions with our supplier community and with our own book of business to help bring those prices down so we can help restaurants lower menu prices and still hit the profitability targets that those individual business owners are hoping to achieve.
Right. It seems like consumers who are looking forward to a spate of deflation are looking at a December even alone where cocoa, coffee up almost 40%, more than 10% respectively. And if there is something you could do to bring those prices lower, what exactly is it at the end of the day? Or do you simply just see consumers shifting their preferences to goods that are cheaper?
Sure. That's a great question. I appreciate it. And we view ourselves as a part of the solution, not the problem, and have a 4-part plan, if you will, to help decrease the pain that consumer is feeling when they go out to eat. First and foremost is to work with our supplier community to bring down costs. We are the largest purchaser of food in the food away from home segment. So leaning in hard with our suppliers to help them be more efficient, be that how we buy, the frequency that we buy, creating competitive environments to have suppliers of like product compete for our business so we can get to a lower net landed price and again pass that value and savings on to our end customers so they can lower menu price. Step 2 is Sysco brand. We offer a private label product under the Sysco banner, and that product is very high quality, and it enables our customers to save money. We say save them time, save them money. It may surprise you that 50% of what we sell to a mom and pop independent restaurant is a Sysco branded product. And we can lean in harder there. We call them swap and save opportunities. Make it clear on our ordering website, make it clear through our 7,000 person plus sales force to share that value with our customers, to educate them. If they swap, they can save. Thing number 3 is to take time out of the kitchen, help them with the opportunity to take labor costs out. So we have prepared foods and the like that we can lean in by cutting the meat in advance of it arriving in the kitchen, cutting the vegetables in advance of it arriving in the kitchen. And those prepared foods are a good opportunity for our customers to take labor costs, because those are the two things that have increased the most for a restaurant. Their food costs are up, their labor costs are up. We can help with providing both of those opportunities. And last but not least is lower cost alternatives. If one protein category is spiking, we can help that customer understand, make the following changes to your menu. You can shift your consumer purchasing to a lower cost of food, helps the end consumer save money, helps that restaurant lower their food costs.
Interesting perspective there, especially when it comes to switching out proteins to maybe save on cost a little bit. We're talking about input costs, of course, the actual cost of, chicken, cattle, et cetera. But I want to talk about tariffs and the potential there. You think about food packaging, for example. You think about produce coming from Mexico and other places. A lot of unknowns right now. Of course, Donald Trump isn't even in office yet. How do you possibly plan ahead for some of the potentials that are being talked about right now, though?
This is a very important topic and appreciate the question. I think the main point of what you said is accurate, which is it's not actually certain what will happen. It is uncertain what specifically will occur. But if I take, again, a giant step back and start with some facts, the vast majority of food that is consumed within the United States is purchased within the United States. And we're a global company. We do business in over 90 countries around the world. In each country that we operate in, the majority of the food is actually purchased within that country. So the impact to our space, the industry we're in, is less than select other spaces. But you mentioned one, which is produce. Of course, during the winter months, a lot of produce that's consumed in the United States comes from Mexico. Yes, we're paying attention to what incoming President Trump has said about tariffs from China to specifically, most recently, Canada and Mexico. And we're taking prepared measures and actions to put ourselves in a position to succeed in helping our customers if those tariffs come to realization. There's some pundits saying that it's a bit negotiating strategy. We don't know, is the honest truth. So here are the things that we need to deliver for our end customers. Thing one, assurances and continuity of supply. Regardless of what happens with tariffs, we need to ensure that we, Sysco, can ship on time and in full to our end customers so that they can keep their doors open and satisfy their end consumers. So that's thing number one, assurance of supply. Because we purchase more food than anyone in our space, we can provide our customers with that confidence that we will have what they need when they need it. Thing two is affordable cost. And if a select individual country sees a spike in tariffs, let's just say we're China, can we source that product from somewhere else? We're working aggressively with our global supplier community in exactly that regard. And we will pivot, we will take actions. It's hard to comment on the specifics at this time when none of us know exactly what those tariffs will be.
Kevin, we thank you so much for joining us today. Of course, a balanced view here on what's going on in the world of food and restaurants. That is Kevin Hourican of Sysco. Now we have some breaking news out of Washington, D.C. House Speaker Mike Johnson speaking to reporters saying, quote, "We are almost there on stopgap funding. Congress has until 12:01 a.m. on Friday to pass a measure to avoid a shutdown." And of course, he does say that that funding is coming together. We will keep an eye on that because, of course, you have Congress working hard to avoid that shutdown. Now let's get a check on markets with Bloomberg's Abigail Doolittle. Abby.
Well, we're looking at a bit of a down day here for the markets for sure, Sonali. This after the S&P 500 fell last week. Right now down about 0.6%. Its worst week in about a week. The same is true for the Nasdaq 100 and the stocks, although the Nasdaq 100 last week higher, in fact, higher into this week, up 4 weeks in a row. Now, a big piece of it, you can see the stocks underperforming. Nvidia down more than 3%. Its worst day of the month. Let's check in on those technicals. It's been quite a while since we've done so. This is roughly a 6-month chart, and you can see out of those August lows when the stock did go below 100, has been climbing, but more recently it's been climbing to equal distant bottom. Recently, today really, breaking below that, right now wrestling with that 100-day moving average. If the bears win, it's very likely that you'll see Nvidia go down to that 200-day moving average. If not, maybe the buyers will somehow bring Nvidia back above the bottom of that topping pattern. In the near term, this pattern looks a little bit cautious. And why is it? Well, let's take a look at the war that's happening within chips over the last 2 weeks. Take a look at Broadcom. This is really incredible, up 40%. Last week, of course, up about 25%. Its best week on record after sort of a mediocre quarter. But the outlook around AI demand for its components really going bonkers. So it seems, Katie, like the folks that need to have money allocated to chips or to AI or want to have money allocated, well, they're rotating out of NVIDIA into Broadcom, and that could continue to put some pressure, of course, on NVIDIA, one of the top point contributors to the major indexes, and therefore we have a little bit of this weakness.
Yeah, plenty of dispersion within the big tech index. Great breakdown there from Abigail Doolittle. Now, coming up, a story about passing down wealth. Former U.S. Treasury Secretary Larry Summers discusses inheritance on today's Wall Street Week chat. This is Bloomberg.
This is Bloomberg Open Interest. I'm Abigail Doolittle in the principal room. Coming up, an interview with Bank of America CEO Brian Moynihan. That's at 3 p.m. New York time. This is Bloomberg.
Well, it's time for our daily Wall Street Week conversation. And a Bloomberg analysis shows that today, inherited money accounts for at least a quarter of wealth for the average inheritor. David Weston spoke with former U.S. Treasury Secretary Larry Summers about taxing that wealth.
If you count what happens when somebody gets an inheritance and then they invest it and that builds up more wealth, that probably the vast majority, certainly a majority of the wealth in our economy is related to inheritance. And that's, of course, a complicated thing. On the one hand, family values are good. On the other hand, it's not like it's equally distributed. It's not like it's even as unequally distributed as income. It's not even like it's as unequally distributed as the rest of wealth. It's really very much a phenomenon about a very small fraction of the population. You know, I think there's a kind of question that you can ask, which is if somebody works hard and earns money, they pay income tax on that. If somebody's born well and they inherit money, the tax on that, which basically adds to their purchasing power, just like income, is much, much lower.
From an economics point of view, why do we have inheritance at all? I mean, why do we get to inherit wealth from our parents or our grandparents?
Well, I suppose the argument is, and I think it's a legitimate argument, that I ought to have a choice as to what I do with my wealth. And I can use it to buy a vacation house. I can use it to buy expensive cars, or I can use it to pass it to my kids to give them a chance. And should I be stopped from giving my money to my children or to my friends or to anything else? So in some sense, it would be a pretty radical position that would say we weren't going to allow people to pass money on or to pass support on to their children or their relatives. My own view is that that's an okay thing, and I think there's a lot of good that's come in this country out of family businesses, family farms, family assets. I do think the extent to which this avoids taxation, even among the very wealthiest people, is something that is very bizarre. You know, your study that was done within the Bloomberg organization estimated that there'll be about $2.5 trillion of wealth passing this year. The collections on the inheritance tax are only going to be about 1% of that $2.5 trillion. Of course, relatively limited inheritances shouldn't get taxed. Of course, you have to treat family farms in appropriate ways. But $2.5 trillion passing, and the vast majority of that being among 5% or 1% of the people who die, and only collecting 1% of it in taxes?
And that was Larry Summers. And I'm pleased to say that joining us now is David Weston, sitting to my left. Really interesting bit there at the end, of course, on the inheritance tax. Yeah. It's a sort of hotly debated issue, as with all taxes, of course. But tell us a little bit more about Summers' thinking on the inheritance tax and maybe how it's evolved.
Well, I mean, he's the first one to say he himself takes advantage of it, and he says he's not temporarily proud of it, but he takes full advantage of what the law provides for his family. His point is basically very few people really pay inheritance tax, and fewer people pay it. President Donald Trump, when he's president again, wants to do away with it altogether. And he says it's not quite fair because there's never income tax on a lot of that money. It gets passed on to the next generation tax-free, particularly with step-up basis, as you know, with property. So nobody ever pays any tax on it. He said that's not quite right.
Where does this fall into the priority order of the Trump administration as they're thinking about the tax cut extensions next year? How much pushback will they get here? Well,
they certainly will go for, I mean, I don't know what they're thinking, but I'm sure that they'll propose it. They'll certainly go for it. They'll have a small majority in the House, as we know. I think most people think that some version of the so-called Trump tax cuts will get extended. And the question is whether they go farther than they've gone in the past with the inheritance tax. I'm sure they'll ask for it. How hard they'll press for it, I'm not sure if it's a top priority. Although some of the people that he's hanging around with these days, it would affect their families.
So we heard from Larry Summers, of course, on wealth inheritance. We heard, of course, a little bit of your conversation with Ellevest yesterday. What else can we expect from Wall Street Week? Oh, well, one of the stories we cover is actually the challenge for places like the BLS, which gives us those jobs numbers. They're getting their budgets cut. And it's harder and harder for them to come up with accurate numbers. As we know, they've had some stumbles in recent days. High-profile ones, yeah.
Exactly right. And they think it's going to be worse. And that's before we have Elon Musk come in and sort of take a look at what they want to cut in the budget. So we talk about really what that could mean. By the way, for us here at Bloomberg and the Bloomberg Terminal, if we're not getting the data, it's not very pretty. And we also have an interview with Margareta Vestager, who is the outgoing EU Commissioner for Competition, and really asked the question, is she the reason, in large part, that there's such a difference between the tech industry in Europe and the tech industry in the United States? There's been such a disparagement between the difference between Europe and the United States.
All right, really looking forward to those conversations. That, of course, is David Weston. And David will be speaking with Bank of America CEO Brian Moynihan at 3 p.m. today, New York time. And, of course, you can also catch David on Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg.
Scott Bessent is set to inherit the worst trajectory for federal borrowing in modern-day history if he's confirmed as the next U.S. Treasury Secretary. The government's debt load now totals over $28 trillion and is projected to exceed 6% of GDP in 2025. And that's the subject of today's Big Take. Joining us now, Liz McCormick, Bloomberg's chief correspondent for global macro markets. It's interesting because a lot of people have been hand-wringing already about the way the Treasury Department has handled the debt issuance schedule to just the sheer amount of debt that they have to contend with. What does that look like going into next year, particularly around this conversation around taxation that the president-elect wants to pursue?
Yeah. Hi, Sonali. Yeah. Scott Bessent has, a big task in front of him, but, he definitely seems up for the job if you listen to some of his recent speeches. But yeah, he's got to balance a lot of things. Part of his objectives, you've probably seen, he calls it like the 3-3-3 plan, is to get real GDP growth at 3%, to get the deficit down from over 6 now to 3% of GDP, and to have 3 more million barrels a day of energy production. But in that, like you mentioned, they do want to cut taxes, or let's just say Trump's tax cuts from his first term are set to expire at the end of next year. They want to continue that. So, but he says you can do it if we do all these things he's laying out, that you can still have tax cuts and still get enough revenue and get the savings you need, that we can bring the deficit down. So he believes, and, some of these are his views. Some are in line with Trump, I'm sure. But he feels like he can do it. But you're right. And he seems to be very weary over the debt trajectory. He said this is an issue. It has to be addressed. We haven't had this deficit to GDP levels besides in wartime and big crises. So he seems very concerned, as like you said, some investors are as well.
How does the bond market factor in? Because, of course, budget experts are worried, but you see on and off again, bond investors also get worried. There's been some talk about bond vigilantes coming out of retirement, perhaps. I mean, do you see that as sort of a disciplining sort of force here for Bessent?
Yeah, I think, well, of course, remember, Katie, as you know, he comes from the market, so he's been living this. And I think what the investors are doing, like we could get there, but we may not have those bond vigilantes of the, late 70s, early 80s when it was like screaming strong, but it's kind of incremental. And you definitely are seeing more and more of the big asset managers saying, hey, we don't like the long end of the Treasury curve because, among a mix of things, but one of them, a big one, is this fiscal problem here, that the debt and deficits are going to keep worsening and that we'll see more term premiums. So I think you're seeing incrementally more and more, and that's why, like, we had the Fed cut, right? And long rates are much higher, right? So I think you're starting to see investors stay away from long-term debt because of this concern.
Right. You see that term premium starting to get more and more baked in, and it's incredible. Even without that, you saw in the fiscal year through September, as you've reported, that the payment on just net interest payments alone are near $890 billion. That is more than the Department of Defense's budget. What does that mean in terms of the plan moving forward? Is there any plan to rein in just how much we spend on interest alone?
Yeah, that's the $1 million question. And I think I will say, like, it's worth listening to Scott Bessent spoke in June. You can find it online for about an hour at the Manhattan Institute. He went into this, but it's interesting because, as we know, the Fed really controls rates, right? It's so ultimately, in some ways, the Treasury Department's hands are tied. But Bessent, in his overall plan, thinks, like, if we can do all this and lower the deficit and boost production of other things that help the economy, he says, we can really bring inflation and inflation expectations down. And then his words, paraphrasing, were, then the Fed can really have an easing cycle. So I think he's hoping, if they get all this other mix right and inflation comes down a lot from the energy side of things they want to do, that the Fed can cut more. But as we know, I mean, the Fed's supposed to cut tomorrow, but the Fed is looking to pause soon. So yeah, their hands are a little tied. That, the average interest costs have more than doubled since, right after the pandemic. So if the Fed doesn't cut much more, it's going to be tough for them, for sure, because interest costs are, like you said, baked in there then.
All right, Liz, great to speak with you, and great reporting, as always, from Liz McCormick. It's our Bloomberg Big Take today about the debt risks that Scott Bessent will have to contend with. You can find it on Bloomberg.com or on your Bloomberg terminal. Meanwhile, quick check on these markets right now. You can see still in the red, and those losses are deepening on the S&P 500, now down about 0.5%. The NASDAQ 100, too, feeling the pain. You can see the big tech index down about 0.6% after hitting a record high yesterday. Of course, we'll see how the board changes when we finally get that Fed decision at 2 p.m. tomorrow, but maybe it's priced in. In any case, coming up tomorrow on Open Interest, Bruce Richards of Marathon Asset Management, Michael Saylor of MicroStrategy, as well as Bess Friedman join us in the C-suite. This is Bloomberg.